Every single time a geopolitical conflict makes the headlines, 99% of retail investors do the exact same thing. And almost every single time, it costs them money. Not because they are stupid, because they are reacting to the wrong signal entirely. Wall Street is not watching the same screen you are. They are not on CNN trying to figure out where the bombs fall. They are following a pattern so consistent, so well documented across 90 years of market history that they have already repositioned before the news anchor finishes their sentence. By the end of this video, you are going to understand exactly why the three things most retail investors do during a conflict guarantee them a loss, what the three phases of market conflict look like, and where the real money is actually being made, and the specific selection criteria Wall Street uses to position during chaos, so you can stop being the one they are positioning against. Let me ask you something directly. The last time a major geopolitical headline hit, US-Iran tensions, a missile strike, a conflict escalation, what did you feel the urge to do? Because I can tell you with a high degree of certainty what most people did. And it was one of three things. The first one is moving to cash. It sounds safe. It feels responsible. You are protecting yourself, right? Here is the problem. Moving to cash during a conflict does not protect your wealth. It guarantees you lose it slowly. You hand your purchasing power over to inflation, and you sit on the sidelines while the market recovers. And it always recovers. Always. You will see the data on that in a moment, and it will change the way you look at this permanently. The second mistake is freezing, just watching, doing nothing while you refresh your brokerage account every 20 minutes with your stomach in knots. You are not protecting yourself in that scenario. You are just experiencing maximum anxiety with zero upside. And the third mistake, and this one is particularly painful because it feels like you are being smart, is chasing. You see oil spike, you see defense stocks jump, and you think, I need to get in on that. So you buy, right at the peak, and then you watch it reverse. Here's the thing. You are not making bad decisions because you are a bad investor. You are making emotional decisions because you are reacting to emotional inputs. The 24-hour war coverage cycle on the news networks, it is not designed to help you make better financial decisions. It is designed to keep your eyes on the screen. Fear drives engagement, and unfortunately, fear also drives terrible portfolio choices. Wall Street is not watching that same coverage and panicking. They are not guessing where the conflict ends or who wins. They are repositioning based on historical patterns. They are following the movement of money across the 147 industries that make up this market. And they are doing it methodically, while the headline machine is doing its job on you. If you had never thought about the gap between how retail investors respond to geopolitical events versus how institutional money responds, drop the word gap in the comments right now. I want to know how many people in this audience are starting from scratch on this today. Now here is where it gets interesting. Because markets do not just fall and recover randomly during conflicts, they follow a three-phase pattern. And each phase has its own behavior, its own opportunities, and its own traps. Think about it this way. Imagine your neighborhood suddenly hears a loud noise at 2 in the morning. In the first few minutes, people turn on lights, some run outside, some lock their doors, dogs bark everywhere. It is pure reaction. Then, about 20 minutes in, people start asking each other what actually happened. And by morning, everyone has adjusted. Life goes on, slightly altered but functional. That is almost exactly what markets do during a geopolitical shock. Phase 1 is the shock phase, and you want to understand this phase because this is where most retail investors get hurt the worst. This phase is characterized by fast, violent movements driven almost entirely by human emotion and automated trading algorithms. Oil prices spike dramatically. The VIX, that is the volatility index, the market's fear gauge, what Wall Street traders call the crash insurance meter. The VIX explodes upward. Risk assets like high-growth technology and biotech sell off hard because investors are rushing for safety. Gold gets a surge as people look for somewhere to park value. Here is the critical warning. Do not try to time this phase. I cannot stress this enough. If you are buying oil or defense stocks the moment the headlines break, you are almost certainly buying at the peak. The people selling to you at that price have been positioned for weeks. You are the exit liquidity. Phase 2 is the repricing phase. This is the smarter phase. The initial panic has burned itself out. Now the market is asking a more sophisticated question. Is this conflict's impact temporary, or is it structural? Are we looking at a brief disruption, or something that rewires supply chains, changes interest rate paths, and reshapes national budgets for years? This is when professional investors stop reacting and start analyzing. They are looking at inflation trajectories. They are looking at potential Federal Reserve interest rate decisions. They are modeling what higher oil prices do to corporate margins across dozens of sectors. This is where institutional repositioning truly begins. Phase 3 is the rotation phase. This is where the money flows to its final destination. And this is where the real opportunity for informed investors lives, if you know where to look. And that framework is exactly what I am going to give you in a few minutes. Wall Street has known this cycle for years. Now you do too. Let me show you what the data actually says. Because I know how it feels when a conflict breaks out and the narrative is that this time is different, this time is worse, this time the market might not come back. I want to remove that fear with facts. The standard S&P 500 pattern across geopolitical conflicts over the last 90 years looks like this. In the first 10 days, markets typically drop 5 to 7%. That feels catastrophic when you are living through it. But 35 days in, markets are generally flat. The losses have been recovered, and 12 months later, markets are typically up 8 to 10%. That 8 to 10% is essentially the historical annual average, meaning the conflict on a 12-month horizon contributed almost nothing to long-term returns. Almost nothing. Do you want specific examples? Let's use 3. The Gulf War. The S&P 500 delivered 11.7% per year during the conflict itself, and then surged 18% in the 12 months following its conclusion. 18%. Not despite the war, after it. The Iraq War in 2003. Markets saw a 13.6% increase within just 3 months of the start of the invasion. 3 months. The Russia-Ukraine War, which is far more recent and feels far more familiar. The S&P initially dropped 7%. That is within the historical range, consistent with the pattern. And within a few months, the market had rebounded above pre-invasion levels. Now here is the asset-level data. And pay attention because this is where most people make their second mistake after the initial panic. Oil historically performs as the best-performing asset during the initial shock phase. Average gain of 18% across major geopolitical events over 90 years. 18%. That sounds incredible. But here is what they do not tell you. Those gains typically disappear within 6 months. The spike is real, the durability is not. If you are chasing oil after the headlines, you are chasing a trade that is already dying by the time you find it. Gold is a completely different story. 6 months after a geopolitical shock, gold continues to outperform by an average of 19%. And unlike oil, gold tends to stay elevated for longer periods. It is not just a shock trade, it is a structural repositioning asset. That is a meaningful distinction. Subscribe if this kind of analysis is useful to you. No fear-mongering, no predictions about where bombs fall, just the structure of what actually happens and what it means for your money. I break this down every single week. This is the part they do not teach regular investors. This is the rotation playbook. And I want to give it to you in 4 specific, usable criteria so you can write this down and actually apply it. Criterion 1. The shovels approach. During the California gold rush, the people who got rich were not usually the gold miners. They were the people selling shovels to the miners. That same logic applies directly to geopolitical conflict investing. Instead of chasing the oil price spike, which, as we just covered, reverses within 6 months, you look at energy infrastructure, pipelines, storage terminals, companies that act as toll collectors on the flow of energy regardless of whether the price of the commodity itself goes up or down. These companies charge fees for movement and storage. They do not need oil to stay high. They need oil to keep moving. That is a completely different and far more durable position. Criterion 2. Defense with multi-year procurement cycles. Single-stock defense plays based on news headlines are a trap. A contract announcement drives a spike, and then the stock drifts. The smarter institutional approach is to look for defense contractors with multi-year procurement cycles and massive backlogs. These companies have revenue that is essentially locked in for years. They do not need the news cycle to sustain their growth. A company with a 3 to 5 year delivery backlog does not care what the headlines say next month. Their revenue is already contracted. You want that kind of visibility in your portfolio during conflict periods, not a bet on which country's defense budget grows fastest. Also pay attention to the unmanned systems and artificial intelligence in defense space. This is a structural multi-year shift in procurement, not a short-term news play. Criterion 3. Pricing power and high gross margins. This one is the most broadly applicable criterion. And it is the one institutional investors consistently prioritize during inflationary conflict periods. Think about what happens when a war disrupts supply chains and pushes costs higher across dozens of industries. Some companies absorb those cost increases and their margins collapse. Other companies pass those cost increases directly to their customers because their customers have no alternative. They need the product regardless of the price. That is pricing power. And it is worth far more than any short-term trade. High gross margins. That is the percentage of revenue a company keeps after paying for what it produces. Act as a buffer against exactly the kind of economic volatility that conflicts create. Professional investors prioritize high-quality businesses with high gross margins precisely because those businesses can survive the chaos while their lower-margin competitors get squeezed out. Criterion 4. What to avoid. This is just as important as what to look for. Utilities and real estate tend to get hit hard during geopolitical conflict periods, not because of the conflict directly, but because of what follows, the expectation of higher interest rates for a longer duration. Here is why that matters. Think of real estate and utilities like long-duration bonds. They pay predictable, stable income. When interest rates go up and stay up, the value of that predictable income stream goes down relative to what you could get from a safe government bond. And in conflict environments, the pressure for higher for longer interest rates is real. Energy costs rise, inflation pressures build. The Federal Reserve does not cut rates into that environment. It holds them up or raises them. And utilities and real estate absorb that pressure directly. Quick question for you. Before today, did you know that utilities and real estate were typically the worst performing sectors during geopolitical conflict periods? Not tech, not retail? Drop the word surprised in the comments if this one caught you off guard. I genuinely want to know how counterintuitive this information is for the people watching this. None of this matters if you do not translate it into something you can actually act on. So let me give you 3 specific practical moves. Move 1. Audit your emotional portfolio behavior. Before you change a single position, you need to understand what you have been doing during past headlines. Did you sell during the Russia-Ukraine drop? Did you buy energy at the peak? This is not about shame. This is about pattern recognition for your own behavior. Your biggest investing opponent is not the market. It is the 24-hour news cycle that is designed to make you act on emotion. Identifying the moments when you let it win is the first step to stopping it. Move 2. Tilt. Do not blow up. This is the professional's approach, and it is the most important behavioral rule I can give you. During conflict periods, your core portfolio should stay intact. You do not go all in on defense. You do not liquidate your growth holdings to buy pipelines. You make targeted tilts, small, deliberate adjustments in your allocation that reflect where the institutional money is flowing. You maintain diversification while leaning into the areas that historically benefit. Never let a geopolitical event become a reason to rebuild your entire portfolio from scratch. The people who blow up their portfolios trying to time these events almost never recover in time to catch the rebound. Move 3. Watch the tape, not the television. Turn off the war coverage. I am serious. It is not giving you an edge. It is giving you anxiety, which translates directly into bad decisions. Instead, watch where money is actually moving. Watch sector performance data. Watch which industries are seeing institutional inflows. Watch the price behavior of the assets I described today. Energy infrastructure, high-margin businesses, gold on a medium-term basis. The tape tells you more than any news anchor ever will. Market rotation during conflict periods can last several quarters. Your goal is not to react perfectly in the first 48 hours. Your goal is to be positioned correctly before the mainstream media starts reporting on which sectors are winning. By the time CNBC runs the segment on why defense stocks are a buy, the institutional money has already been sitting in that position for months. Do you think retail investors should have access to the same pattern-based research that institutional clients receive? Drop your answer in the comments. Because the gap between what professional investors know about these patterns and what regular investors are told is exactly why this channel exists. Here is what we covered today. 90 years of market data shows that conflicts follow a predictable 3-phase pattern, and the investors who understand that pattern avoid the 3 emotional mistakes that cost most retail investors money every single time. Oil spikes during geopolitical shocks are real, but they reverse within 6 months on average. Gold is the more durable play, continuing to outperform by an average of 19% 6 months after the shock. And the professional framework for conflict investing is built on 4 criteria. The shovel's approach to energy infrastructure, defense companies with multi-year procurement backlogs, businesses with high gross margins and pricing power, and avoiding utilities and real estate during higher-for-longer rate environments. The one thing I would do right now if I were starting from scratch is to pull up your portfolio and identify which of your current holdings fall into the sectors that historically get hurt during conflict periods, utilities and real estate in particular, and assess whether your exposure there is intentional or just something that accumulated over time without a thesis behind it. That one audit, done today, can save you significant pain the next time a headline moves the market. If this kind of analysis is useful to you, subscribe so you do not miss what comes next. And drop a comment below telling me what is the one investing mistake you have made during a past geopolitical event that you now understand differently after watching this video? Take care of your money, and I will see you in the next one. Next week, I am getting into the specific signals that tell you which phase of conflict the market is currently in, because knowing what phase you are in changes everything about which moves make sense.